Welcome to Making Retirement Make Sense, the podcast that helps you build a better retirement. Each episode, you'll hear from the industry experts about the issues that matter most to your plan, no matter where you're at on your retirement journey. From pre-retirement to the later years, we've got you covered. Let's make retirement make sense together.
Welcome to the Making Retirement Make Sense case study series, where we walk you through real financial plans and show you how the experts approach retirement's biggest decisions. Joining us today is partner and executive financial planner, Amy Shepard. Amy, how are you?
I'm great, CJ. How are you doing?
Good. I always love these case studies. Today we have on deck a really important one, especially for this time of year. We're recording in October 2025, and so every time the fall comes around, we are knee-deep in what we call tax projections. And so it sounds like kind of a vague term if you don't do this professionally, but what makes a tax projection really unique, the way I think about it is that a lot of our planning is broad, right? We're doing 25, 30, 40-year out projections. And so you have to look at the big picture. But what a tax projection helps you do is look at just this year and say, okay, what is my 1040 for, in this case, 2025's tax return really going to look like? And are there any year-end action items? Is it aligned with what I thought I was going to do in kind of the big picture projection? And so, Amy, I know you've teed up a tax projection today, and you're going to walk us through how to do one.
Yes, that is the plan for today. So what we're going to start with is looking at the client's plan. So like you said, it starts off with a 30 or 40-year plan, and then we narrow down each year of, okay, how does it compare to what we thought? And then how do the decisions we thought or the action items we thought we were going to take, how do those maybe, change, or do they stay the same? That's what we're going to look at today. So I am going to start first by showing a version of a sample plan. Meet Sue Sample. That's who we have today. So I have done lots of videos, and so the picture up on the screen here may look familiar, but it's a comprehensive financial plan. And so that's the first thing I want to show. What we're going to focus on is the 2025 column of how are the things in this plan going to translate into our tax projection exercise. And so first thing is if we just scroll through this spreadsheet, this is, like I said, it's a comprehensive financial plan. There's a lot of detail in it. It shows a client's income sources. That's what you see up at the top. This is a client who has pension income only. They're not working, so no earned income. If we scroll farther down, we can see some of the withdrawal information for this client. So what I highlighted in orange, it shows a potential Roth conversion. I'm going to spend a minute on that because initially, when we made this client's plan 3, 4, 5 years ago, however long ago it was, we had actually planned for a huge Roth conversion. So the number you see on my screen is $65,000. We actually had planned more like $165,000.
Okay. And for the listeners at home that may be a little less familiar with some of these topics, really what a Roth conversion allows you to do is pay tax on pre-tax IRA money today, so that ultimately you could take advantage of being in a lower income tax rate if it makes sense. And the trade-off to that is, well, then you pay more in taxes this year.
Yeah, and so there's a lot of nuances here. So if I looked at this client's 2024 plan, we had $165,000 in here. The reason for that was because 2025 was supposed to be the last year of current tax laws. In 2017, the Tax Cuts and Jobs Act, that was a bill that was passed. It temporarily reduced a lot of different tax changes. Well, then this year in 2025, we had the one big beautiful bill that, I'm going to do what CJ does, permanently extended the current lower tax rates. So there's already been a few variations of this client's plan, and we're just getting started. So first, we thought $165,000 was the right number. Now, going into the tax projection for the current year, we said, well, maybe we do less. Now that we don't have this increase in taxes coming next year like we had thought, $65,000 might be the right number. And so I'm going to start there, and I'm going to take the numbers from this plan, and I am going to show how it translates to our tax projection software. And so we use Holistaplan. That's what I have up on the screen here. It has Sue Sample's, 2024 tax return. That's scenario 1. That is her last year's tax return, exactly as filed. And so we always like to start the tax projection exercise with what happened last year, using that as a baseline. Before I start to jump into anything else, any thoughts floating around in your head, CJ, or questions or comments?
Yeah, well, the one thought that I think is that for the listeners at home, it's really important that you use tax software to do these projections. Our listeners and our clients know we love Excel, and we're able to do a lot of preliminary tax planning in that spreadsheet, but there are all kinds of nuances in the U.S. tax code and even in state tax code that can impact these decisions. Even if the recommendation still ends up being confirmed and makes sense, you might discover other opportunities to layer in, or even that you need to adjust things like your estimated tax payments, which we'll probably talk about later in this video. And so we use one called Holistiplan. There are several others available, but definitely take the time and use software. And I do think ultimately, if you're just using just a general financial planning software of any kind and using that to make your final decision, you're probably not optimizing fully for how good your strategy can be in implementation.
Yep. So that's step number 1 in the tax software is have your last, most recent tax return data. That's scenario 1. Scenario 2 is what I just alluded to, showing you the plan. It's, the current year tax projection, assuming we do a Roth conversion of $65,000. So what we're going to start with is we're going to walk through scenario 2 line by line. So, like we saw in the plan, this client has no wage income. What they do have is some interest, some dividends, so, investment income. Their taxable interest in 2025 is estimated to be less than it was last year. That's one thing you notice. What we do is actually we look at both Charles Schwab, that's the custodian that we use at my firm. So we estimate what the Schwab interest is going to look like. And then this client happens to have a online high yield savings account. We have that interest estimated in here as well. So one of the key points, hopefully we'll mention this a few times through the video, but it's a comprehensive tax projection. We have to know the client's whole situation, not just the things that we may directly help them with.
Amy, there's a line on the projection that says qualified dividends. Can you explain a little bit about the differences between kind of total dividends and qualified and how they're taxed differently?
I can. So the qualified dividends are subject to long-term capital gains rates. Those are typically more preferred rates. There's a 0, 15, and 20% rate at that level. The total dividends, it includes the qualified dividends, but then it also includes what are called ordinary dividends. Ordinary dividends are not taxed at the capital gains rates. Those are taxed at ordinary income rates. So there's a quick explanation.
Absolutely. Yeah. For the viewers at home, your 1099 will determine whether or not you have qualified or ordinary dividends. Most equity investments, once they're held for a certain period of time, which is not that long, it's typically a few months or up to a year, they will classify for qualified dividends. But there are some that don't, particularly, funds with interest income like bond funds or money market funds oftentimes will not be qualified because they're not, equity dividends.
Yep. Yeah, we see quite a bit of money market dividends in our projections with interest rates the way they've been. For most of this year, they just went down a little bit, but money market funds have been paying, 4%. So we have a lot of dividends coming from those money market funds. So going down this scenario 2 line item, we also see this client has taxable pension income. It's more than it was last year, and that's because Sue started her pension last year. She didn't have it for 12 full months, but in 2025, she will have it for 12 full months. So there's an increase. This pension happens to have some tax withholding on it. So if we click on it, we see the gross amount of pension income, just under $17,000. And then there's a really small amount of federal taxes being withheld, but that's factored in here.
Now, Amy, for actual implementation of this, we typically require quite a bit of documentation. Most people that have pensions or Social Security income, they might not necessarily know the withholding off the top of their head. I know for me, I never remember what I elected every time I have to file one of those W-4s. Can you just explain where maybe somebody could find the withholding if they're trying to conduct their own tax projection?
Yeah, the best place to find it is going to be on a monthly pension pay stub or pay statement. That's always where I recommend people go to find it. So you can log into your pension website and usually generate a monthly statement. It would be there.
Thank you.
You're welcome. So then if we keep moving through this tax projection, scenario 2, we see that $65,000 Roth conversion. So we have that in there. As we keep going through, what I'm looking at as the planner here is I'm seeing, do the things in scenario 2 match what the plan had, that spreadsheet? And then I'm also eyeballing what's the difference between scenario 1 last year and scenario 2, what I'm looking at for this year. So we see a difference right here. Long-term capital gains. Last year, the client had about $34,000. This year, in the current projection, what we're going to model first, we have no long-term capital gains. This client does have brokerage accounts, but she doesn't own any mutual funds in those brokerage accounts, so we're not anticipating any capital gains distributions. The only capital gains that there might be is if we proactively choose to incur some. So as we keep going down, we have, total income estimates. We have AGI estimates. We have, standard or itemized deduction. Another big difference. Last year, there was a significant amount of deductions. She itemized. This is a client who did pretty considerable charitable gifting last year. So that's a topic for another video. But what happened there with that $68,000 of deductions was a strategy people often call bunching. This client put about 5 years of expected charitable giving into a donor advised fund.
Oh, yeah, that's really prudent, it's in many cases. And the reason you might do that is if you're planning to use the standard deduction for, the foreseeable future, like a lot of people will be now that it's been, at the expanded limit for, quote, permanently.
Yeah.
You ultimately don't get as big a bang for your buck for charitable giving if you don't itemize.
Right.
And so oftentimes we'll say, well, hey, take all the money you could be giving and gift it in 1 year where you can kind of optimize that tax benefit. And there are changes from the newest tax bill that also impact even your ability to deduct charitable fully through your itemized deductions. So those rules are ever changing.
Yes, they are. So this client this year, the plan is, no significant charitable gifting. We did that last year. So standard deduction is what we're expecting. As we keep scrolling through, we see some different tax credits. One big one I want to point out is the premium tax credit. So this is a client who has been using insurance through healthcare.gov. And when she applied for her insurance at the end of 2024, she said, Amy, they're asking me for my income for 2025. What do I put? And so at the time, we had discussed using a really high number. I think it was about $190,000 because our plan at that time was to do $165,000 Roth conversion and then have interest and dividends. And so we thought her income would be pretty high. Because of that estimate, so by using that high income number, all of 2025, she has been paying full price for her health insurance. She has not received any, what people think of as subsidies. She's been paying full price. Well, now when I look at scenario 2 and I think, we changed our mind. We changed our strategy because of the tax changes. Now we think we might only do a $65,000 Roth conversion. And if we do that, she may qualify to get back a tax credit that would have, if we had used a lower income number, she would have received a tax credit every month to lower her insurance premiums. But since she didn't, she can now get that tax credit back when she files her tax return.
That's really nice to know. And so, because a lot of the time you don't know what your income's going to be, especially in retirement. Maybe you realize more capital gains because the markets are doing well. And, for the risk of having to get a refund, it's not really risky. That's a good thing. It's better to err the estimate upward. But we've also seen the opposite, where there are cases where you listed your income's going to be, $10,000 and it turns out to be $200,000. And then you have to pay back in your tax return what you were given in the monthly subsidy.
Yep. I have a scenario like that I'm working through with a client. We estimated $40,000 last year and it's coming in at like $53,000. So they are going to have to pay back a little bit of the subsidy they received. So back to Sue, that's one thing to consider. I was like, okay, now if we do this smaller than initially planned Roth conversion, she may get a refund. She may get this tax credit for health insurance. in this scenario too, if we do what we've been talking about, the $65,000 Roth conversion, what it looks like is she'll end up owing, for the year, her total federal tax will be about $10,000. And the client will be in the 22% tax bracket. So if we go up here, we can see ordinary income bracket, she'll be, 22%. State tax. So this software is also really great because every state has their own tax rules. This client happens to be in Illinois, which is a pretty favorable state to be in for retirement planning purposes. So one great thing is this state tax return. If we did that Roth conversion, Roth conversions are considered retirement income in the state of Illinois. So that client's pension of $17,000 and the $65,000 Roth conversion, they're excluded. So you see this big, almost $82,000 of excluded retirement benefits. That's not taxable in the state of Illinois. And so in this scenario, if we come all the way down, we see this client, her state tax is estimated at under $700. She hasn't paid any in yet, but she wouldn't need to, because if this is what really ends up happening and she files her taxes in the spring and she finds out she owes $679 to the state of Illinois, it's under $1,000, so there's no penalties, there's no quarterly payments that are needed. Any questions there, CJ? Because I know I'm saying a lot of things that I know in and out, but they're all very nuanced.
Yeah, absolutely. Well, Illinois is my home state, so I was raised there. And so if you're like me and you're planning to move from Illinois anytime soon and you're retired, it could be worth doing the Roth conversion or accelerating income before you do.
Yeah.
I think this projection is great. I do have some questions just about how do you actually finalize the numbers? Because it's one thing to have it in an Excel sheet and say, okay, we're kind of working off that. But especially on some of the items like investment income, like we've had clients where, they use last year's as a proxy. We have others where that's not really relevant because maybe they had, a home sale or something and they have these proceeds, like their cash situation changes. How do you navigate that year to year, with your clients? And when you're actually building these projections in detail, how do you reconcile some of those things with, hey, should I use last year's? Should I use the Excel sheet? Should I go pull statements? What's your preferred approach?
A little bit of all of those things. So I do like to use last year's as the baseline. But then for the current year, especially for a client who has brokerage assets, I do like to use more of a fine-tooth comb and actually go in and look at what is their interest year to date, what are their dividends year to date. And so in this example, we did use current year numbers to try to estimate interest and dividends for the year. And then we also compared it to last year. And so if you remember, last year, I think this client showed about $14,000 of interest. This year, we're estimating a little less at $9,000. A mental check for me is to just say, are those numbers close? If they're different, well, why? Why are they different? So I do use a combination of approaches. Is there anything different you do?
Yeah, well, it depends on the circumstances too. So two cases that I'll mention. One is that you're going to want to be cautious of that investment income, those dividends that pay out. The reason that those are so tricky to plan on is because ultimately you're not in control of that. When you hold an investment, the investment determines what gets paid out. And there are certain funds that you can buy, a collection of equities, where you see a very high degree of variance each quarter, or even with what are called capital gain distributions at the end of the year. And so I think if you have a large non-retirement account balance, you should be really careful about just assuming that last year's will be this year's, even if you haven't made any major portfolio changes. Because we've seen cases where, a fund will have a lot of turnover in the middle of the year that they didn't have last year and have these huge distributions that you couldn't count on. So that's the first thing. And, the second, aspect of the plan that I'll mention is the reason we do this in the fall is because more of that information gets known. I get asked all the time from really, I'd say, astute clients or prospects or just people that follow our work, and they'll say, well, isn't it better mathematically to do the Roth conversion as soon as possible in the year? Do it in January because most of the time markets go up, and so then you have the money growing tax-free sooner. And my answer to that is typically actually no, because in certain cases, you're going to end up making a decision on how much to convert before you have a full picture of the information.
Yeah.
And once you take that action to realize capital gains or do a Roth conversion, you can't back out and change it even a month later. So like we've had cases where clients did a Roth conversion and then needed extra cash for a shock expense. And then, hey, well, we could have done an IRA withdrawal instead, or we decided to sell something in the portfolio later in the year that would have changed our approach. So it's actually typically better to wait. Really, and it's hard because as planners, we want to not wait on things and be proactive. But when you mention things like even the healthcare subsidies, a lot of these provisions have cliffs. And so the other case, if you have a non-retirement account balance, I say it's worth waiting till closer to the end of the year. The other case where it's worth waiting is if you're subject to one of those cliffs where if your income goes over by $500, it completely eliminates an opportunity. A lot of the tax codes in phase outs. So if you go a little bit over, it's not a huge deal. But there are other things like your Medicare IRMA adjustments and things like that will adjust if you're just $1 over.
Yep. Yeah. So the whole point of what I just walked you through, scenario number 2, is like, what could the numbers look like? And then also, and most importantly, should we do it? Should we do scenario number 2? Well, how do we decide that? The way to decide if we should do it or not is to actually look at the client's plan, look at their situation. And so one of the things I want to show is an overview of, this client's first portfolio. So what you see is this is a client that has, brokerage assets. That's these first 2 accounts, about $400,000. There's, under $900,000 in IRA assets. Those are, traditional retirement assets that are going to be taxed upon withdrawal. And then this client also has a pretty significant Roth IRA, over $800,000. And so when I think of this client's, financial picture, as I'm showing you here, and then I also think of this client's goals. Their goals are, when they're no longer here, they do want their assets to pass to their children, but they don't have a set legacy goal of saying, I want to leave X amount of money. It's just what's left, I want to go to my kids. And in the meantime, I want to make sure that I can enjoy my retirement. And so knowing that, and then knowing the client already has a healthy amount in a Roth, I'm like, I don't know, do we do the Roth conversion this year? Is it going to add any value? Another way I evaluate that is I go back to the client's plan and I look at what their tax picture looks like over the life of their plan. And so for this client, if we look at what tax rate we expect them to be in throughout retirement, they're expected to be in a 22% tax bracket for many years. Now, a lot of that is intentional. In this client's plan, every year for the next 5-6 years, we have either Roth conversions or IRA withdrawals planned. We're proactively trying to get money out of that traditional IRA sooner to prevent a tax rate in the future from when RMDs start. So we did a whole other video on that explains that. But for this client, we're expecting about a 22% tax rate for several years. Then they drop down to a 12% tax bracket. This is because Social Security is expected to start at 70. When Social Security starts at 70, we stop potentially proactively doing Roth conversions and IRA withdrawals because we don't want to have kind of a double tax situation where we're taking money out of an IRA that gets taxed. But then, since the client has Social Security, by taking money out of that IRA, we're now causing more of the Social Security to be taxed. So this client will potentially enjoy being in a 12% tax bracket for some years. And then eventually RMDs start at age 75, and you see this client is, potentially going to be in a 22% tax bracket throughout retirement. So that's one factor I look at. I also look at Medicare. How does that potential $65,000 Roth conversion impact this client's Medicare premiums? Well, this client isn't on Medicare yet. They're 64 this year. They will go on Medicare next year. But the decisions they make in 2025, what shows up on her tax return is going to impact her Medicare premiums potentially when she's 66. So Medicare premiums are always based on your tax return from 2 years prior. For this particular client, if I look at their Medicare situation, I highlighted in orange here, but what you can see is that This line 336, it shows how much room is left in the lowest Medicare bracket. In other words, if we were to do this $65,000 Roth conversion, it leaves about $7,000 of room before this client would trigger higher Medicare premiums. And so again, that is a topic of its own. We could talk about that for a whole video. But when I'm looking at this client's plan and I look at their expected Medicare costs throughout retirement, I see that they are in the lowest Medicare bracket for all of retirement. As time goes on, there's actually more room in that Medicare bracket. And so when I'm looking at future tax rates, when I'm looking at future Medicare costs, I'm not really seeing like, oh, this $65,000 Roth conversion is really going to make a difference for this client. So let me pause there, CJ. What thoughts or comments do you have on what we've covered so far?
I think that when it comes to Medicare planning, what I like about the template is that it allows you to look at everything holistically. And so, I really am glad that you look at that. Now, you mentioned leaving $7,000 of room. I know that was kind of just a random number for the sake of this projection, but is there a buffer when you're looking at like filling up a certain rate where you might say, hey, let's say it's $53,000 to fill up the 22% tax rate. Would you say, hey, maybe back that off $5,000 in case something comes up unexpected that, when you go to file your return could push you over?
I do love a buffer. Typically, what I try to do is use round numbers for things I can control, like a Roth conversion. And so in this case, I specifically picked a $65,000 Roth conversion because it's round. And then I knew by doing that $65,000 Roth conversion, I'd have about $7,000 of buffer. I generally like to have somewhere between $5,000 and $10,000 of buffer. And so the $65,000 Roth conversion number is what influenced that. If I did $70,000 of Roth conversion, that would only leave a $2,000 buffer, which I don't really like. And if I did $60,000 of Roth conversion, then I'd have a $12,000 buffer. So it is not an exact science, but the spirit of that is to just keep some wiggle room because the Medicare buffer in particular is, like you just mentioned, CJ, it's a cliff. If you go over by $1, you pay higher premiums. And so I try to avoid that.
Great.
Yeah, great question. So one other thing I look at for this client, in addition to tax rates, Medicare, I also look at what we call their bond ladder. And so I'm going to show a different screen here, something we call a floor report. What this shows is for this client, in her traditional retirement account, what you see are numbers that indicate how much in bonds and CDs are maturing every year. What this shows is for the next 4 years, this client has bonds and CDs maturing in her IRA. The top number here in white, like for 2026, it shows we're expecting a withdrawal of $75,000 from her IRA, but we have $112,000 of bonds and CDs and their corresponding interest available, which means if the client really takes $75,000 out and all those bonds and CDs mature as expected, there's going to be extra left over. That extra can get reinvested. It can be extra spending money. It can get rolled forward to buy more bonds. There's a lot of options. But when I look at this client's IRA, I see we have extra every year for the next several years. What I also look at is what about this client's income ladder in their brokerage account? And so if I come down here, it looks a little bit different. So here we have bonds and CDs maturing every year. There is some extra, but not a significant amount of extra. And so I start putting all the pieces together and I say, I don't think that $65,000 Roth conversion is really going to make or break the client's future tax situation. I don't think that $65,000 Roth conversion is going to have any material impact on future Medicare. But I do think that this client could benefit from maybe extending their income ladder in their brokerage account. And so maybe what I want to do instead of all this Roth conversion talk is maybe I want to realize some capital gains in the brokerage account so I can generate cash and buy a bond or a CD in the brokerage account. And so as I'm looking through all this, that's where I came up with scenario 3. I started with the initial plan. I said, what do I think? We just talked about that. And now I'm like, I'm going to go back to the drawing board and test something different. Any questions on that so far, CJ?
No, just to clarify, so the reason you're looking at the portfolio now is to say we want to align kind of what's going on in the investment world and the need of the client from a cash flow standpoint with the tax projection. And you have to be able to integrate those two things because ultimately, let's say you do the Roth conversion. Well, that also means that your income ladder is going to be shorter because you're paying more in taxes here.
Yep.
And so I think it's really important to be able to evaluate those lenses separately, but also in a way where you can integrate them. And this process is really helpful for that.
Yes, it is. It really helps you just look at all the different decisions. And at the end of the day, I don't really think one is the right or the wrong decision. They're all good decisions. It comes down to the client's plan, the math, but also what the client feels more comfortable with. And so we're going to look at a third scenario, which is, should we just skip the Roth conversion and maybe consider realizing some capital gains? So I'm going to go back to the tax software and we're going to walk through scenario 3, which is basically identical to scenario 2. It has the same amount of interest and dividend income, same amount of pension income. What it does not have is Roth conversion. So you see scenario 3 is 0, where scenario 2 we had talked about maybe 65,000. The other difference is instead of having 0 in long-term capital gains, scenario 3 says, well, what if we do, 25,000 of capital gains? And I'm sure CJ is over here thinking, well, why 25,000? Where did you come up with that number? 25,000 comes from the potential ability to realize that amount, 25,000 in long-term capital gains at 0%. And so it's another one of those buffer type scenarios. If I go back to the client's plan, we do a lot of playing around in Excel, but one of the things that I can do here is I can say, oh, you know what? I actually can't say this. I don't have my keyboard. But if I were to zero out the $65,000 Roth conversion and instead put $25,000 of capital gains right here, what this would show me is that I have a little bit of buffer. I have a little bit of room in the 0% capital gains bracket.
Amy, I just impromptu thought of a way maybe we could illustrate this on the fly for our viewers. Can you go back to Holistiplan?
We can. Do you want to do the min-max?
Oh, or the range calc.
Yeah,
if you
we
just
can look at
remove
that.
the capital gain from scenario 3 and then bring up the range calc. And for the audience, this is going to be really useful for those of you that are visual as opposed to those that are not. And so really what we're looking at here is the black line at the very top is the effective rate on the next amount, the next $1,000 of ordinary income being taxed. And so if you were going to do a Roth conversion on top of what's been included in this projection, well, it's going to show you the tax impact of that. And so what's great about these charts is that they have them for ordinary income, but then if you scroll down, they'll also show it for capital gains. And so in this very specific case, you'll see there is technically room in the 0% rate, which would be that red section. But then there's this weird purple section. Can you explain what that is?
The purple section, I'm going to let you explain it, CJ. Cause...
It is. It's the premium tax credit.
Okay. Yes.
Yeah. And so a really important concept here. Go back to the main projection, Amy. If you go to the Roth conversion and click on that box to edit it, this is a good illustration here
right
in scenario 2.
Saying, yep.
Yeah. What you'll be able to see is the effective rate on the conversion itself. And so the reason this is important is because when you're evaluating any kind of Roth conversion situation, you can look at the marginal rate, but that's not going to exactly tell you the full picture. Like in this case, this client has those healthcare subsidy tax credits.
Yep.
So every dollar that you convert, you not only pay ordinary income tax on that, but you're also paying an effective tax by losing some of the premium. It's kind of like you're getting double hit for $1 of income. And so that's what the chart really illustrates. This does the math for us for conversion specifically. And so like in this case, the $65,000 conversion, I'm not surprised it doesn't look as good in the big picture plan because you're paying an effective tax rate of 28%.
Right.
because you lose the subsidy.
Yep.
And so just looking at the marginal rates doesn't tell all the picture. One more reason for tax software. And so what we would see if we had a keyboard is basically you could zero out the capital gains and you would actually see that there's a lot of room before even maybe you lose some of the healthcare premium subsidy.
Yep.
Or for clients that don't have that limitation, ultimately, we see a lot of cases where you could realize $50,000 to $55,000 of capital gains and pay nothing in tax. That black line's at the bottom of the chart.
Yep. Yeah. So for this client, after thinking through all of that, and after coming up with that, $25,000 number to try to keep capital gains at 0%, what does this translate to? Well, CJ mentioned it, but one of the big differences here is now without the Roth conversion and having some capital gains, if we go back to the healthcare tax credit, now this client is getting more than double what they would if we did the Roth conversion. So they are getting potentially about $6,500 in tax credit to offset the high healthcare premiums that they've been paying this year. And so if this was the scenario that we decided to go with, what does that mean for kind of the results of the tax return? So in this case, if we do scenario 3, we realize the capital gains, this client ends up, having total federal tax of about $1,700. They've already paid in some, so they had a refund in 2024 that got applied to 2025. They had that small amount from their pension, and then they had that massive tax credit that I wouldn't say discovered. We knew it was there, but we fine-tuned to take advantage of it. And so now this client's realizing capital gains, they have pension income, and they're, expected to get a $5,600 federal refund. That's the federal side. Something really unique about state for this case, CJ actually mentioned this earlier on when we first got started, but all states are different, and there are a lot of nuances. So in the state of Illinois, if we were to realize capital gains instead of a Roth conversion, capital gain income is not retirement income. And so the state of Illinois actually taxes capital gain income at a flat rate of 4.95%. And so I find that a bit fascinating if you were to compare scenario 2 and scenario 3, because in scenario 3, there's less income. AGI is lower, taxable income is lower, but state tax is higher because there is, there's no exclusion there. It's not retirement income. We can't keep it off. And so if we go with scenario 3, the client doesn't have to do anything with federal taxes, but they would have to make what's called a quarterly estimated tax payment to the state of Illinois, likely of about $1,900, so that when they file their state taxes, they've paid in enough of their current year tax liability to avoid being hit with any underpayment penalties. So that's another bit of lingo. We can do a video on that at some point. But CJ, what are your thoughts or comments on all of those details?
Well, I think that that last piece there, the estimated tax, matters a lot. And so whether you choose scenario 2 or 3 in that position, ultimately you need to be aware of how do you need to adjust your payments. And there's really 3 ways you can go about it, right? One is you pay in based on last year's tax. Well, for this client, their tax picture's changed quite a bit. And when you're making these quarterly payments in advance, a lot of the time you end up with a really sizable refund, and the IRS doesn't give you interest on that money when you pay it early. So a lot of people don't like to do that. In some cases, it's the opposite, where you haven't realized most of the income. You don't know what your picture is going to be yet until the fall when you make these decisions. And so, scenario 2 is you kind of wait. You do the projection, and then once you realize the gains or do the conversion, then you make one big payment. And I say that because there's one big caveat to that. We don't need to get into all the details, but one thing everybody should know is that when you do that, the IRS doesn't automatically say, oh, hey, you realized all your income in fourth quarter, so you didn't need to make payments until then. They don't have a way to know that unless you tell them. And so there's a provision in the tax forms that you can use when you file your return, and it's called the annualized income installment method. It basically is a different way to calculate your estimated payment requirements. And so if you're somebody that maybe is just not paying in anything because you don't think you have to, and then you make a decision to accelerate, you could get hit with underpayment penalties if you don't address that properly when you file your return, even if you make all the payments that fourth quarter like you're required to.
Yep. Great, great point. So I have worked with so many new retirees that didn't even know what a quarterly estimated tax payment was because they've worked their whole life. They had a salary, taxes were withheld from their paycheck and it was easy. And then they get to retirement and they have income coming from retirement accounts and capital gains income and pension income. And they're just like, how does this impact my taxes? And so we factor that in.
So, Amy, we've talked about two scenarios now. So it sounds like we have options. And like you said, they're not necessarily, there's not one good and one bad option. There are two choices.
Yep.
What would you choose in this case?
So what my recommendation was for this client was to do scenario 3, the capital gains option. The reason for that was partially, what we looked at with the fact that this client has a significant amount of Roth assets. The Roth conversion doesn't materially, seem to benefit them in terms of tax savings or Medicare savings. And if we do the capital gains, the client can get a big refund. And that big refund is coming from tax subsidies. One of the big changes recently with healthcare.gov is what subsidies are going to look like moving forward. And to me, it feels like a pretty great benefit to be able to take advantage of that premium tax credit in 2025 because there's going to be significant changes in 2026 and beyond. And so I like the idea of taking advantage of the tax credit, and I like the idea of realizing capital gains with minimal tax impact. And then a third point to that is what we would do with that $25,000 of capital gain income is we'd use it to extend the client's income ladder, which is where their retirement paycheck comes from. And so that was my ultimate recommendation.
Great. I'm glad because that's exactly what I would have done too.
Well, that's always good to hear that we're on the same page.
Absolutely.
Yep.
Well, thank you so much, Amy. Any other final thoughts or takeaways you want the audience to hear?
I think the only thing I will add, CJ, is you mentioned tax projection season, that we're knee deep in it. I would say waist deep. It's a busy time of year. This is just one example, and we do these for all of our clients, and every situation is so different. So it's a valuable use of time. We look at a lot of different things.
Well, then as a planner, I really enjoy doing it because it just gives me more confidence in our approach. And the hard part about retirement planning is that, a plan is really easy to put together. I mean, there are nuances, but it's at a point in time. The hard part about retirement is actually managing and executing. And that's where it's ongoing and things can change on a daily basis sometimes. And so, you have to stay up on it. And this is just one way that allows us to manage and execute according to, those planning parameters.
Yep. Yes, that's exactly right. Well, thanks for having me, CJ.
Yeah, thank you for your time. Well, thank you all for listening to a Making Retirement Make Sense case study. We really appreciate it.
We hope you enjoyed this episode of Making Retirement Make Sense. If you found it helpful, please like, subscribe, comment, and share it with someone who you feel could benefit from what we discussed today. And if you're feeling extra generous, we'd welcome a review on Apple Podcasts or Spotify.